Hi, I'm Leo Young, and in this video, I'm going to answer the three most common questions I get asked by investors like you. So the first one is, why real estate? Second is, why mobile home parks? And three is, why invest with us? So let's dive in. Okay, so first question is, why real estate? I mean, there's so many different options out there. You could buy stocks, crypto, gold, but a lot of people choose real estate. Why is that? So here are a few main reasons. The first benefit is that it'll give you a steady stream of income. Most likely, when you buy a piece of investment property, you're going to want to rent it out to a tenant that pays you a rent. So that gives you a predictable stream of income, and many people like that because they equate that to the money sitting in their bank. So call it right now, if you're getting 3-4% from your bank, instead you can rent it out and get 5% or more. They call it cash on cash. Then it makes more sense to invest in real estate. The second reason is that you're providing a useful service to the economy. People don't really think about the impact of their investments, but with real estate, it's especially prevalent because you're very close to your impact. So let's say you're providing affordable housing, which is what we invest in. You're providing that as a service to the economy, which is very helpful. As you know, there's a huge housing shortage in the United States right now, and us providing this service is essential to the economy's growth. The third benefit, and this is more related to commercial real estate, is the concept of forced appreciation. So unlike residential real estate, where the value of the property is comparable based, so how much your neighbor down the street sold their property for, commercial real estate is multiple based. So valuing how much this stream of income is worth and multiplying it by a multiple called a cap rate to get your value of the property. So with commercial real estate, it's really easy to force the value of the property to go up. And you do that by making the property more profitable. So increasing your revenues and decreasing your expenses. And why investors like this is because this is a very predictable way of generating value. If you want to increase the income, you increase your rents. If you want to decrease your expenses, you negotiate with your vendors. These are tried and true methods of increasing the profitability of your property. Unlike a small business, for example, are you missing marketing? Are you needing more sales? Do you need better supply management? You don't know. So with real estate, it's much more straightforward. And finally, our tax advantages. So what I mentioned before, that we're providing a useful service to the economy, the US government sees this and they want to promote this kind of activity with the US tax code. So they give us investors a lot of tax benefits so that we keep more money in our pocket end of the day. This is a huge advantage for real estate investing because if you make the same amount of profit from stocks and real estate, you keep more after taxes for real estate, and you can take that extra that you make from real estate and reinvest it, and you know the magic of compounding interest. That difference gets bigger and bigger and bigger over time. And this is why 90% of all millionaires do so through real estate. Next, here are some common paths for real estate investors to invest. The first off is to invest in a rental property yourself. That's what most people think about when they think of investing in real estate, right? You buy your own investment property, you get your own tenants, you screen them, you operate the property, everything. Now, obviously, the benefits are that you have more control over the property, you can learn a lot through doing, and you can even get pretty great returns if you do it right. And of course, the tax benefits that I mentioned earlier. Now, the drawbacks are that typically when you invest in your own property, you require the most amount of money up front. So you need to save for a long time to be able to get that property. It's not liquid and it's not passive either. So if you're having another day job, then your investments would effectively take time away from your day job. And you need to think to yourself, is my time best spent responding to my tenant's phone call about a leaky bathroom? Because you will get calls like those. Even if you have property managers in place, tenants will call you directly to complain all the time. I'm speaking from experience. Now, okay, maybe investing in property is too much hassle to do yourself. So you want to take the most passive route. So you can invest in a REIT. REIT is a real estate investment trust. So it's a publicly traded company on the stock market that buys huge buildings. And the benefits are that it's very liquid. You could buy and sell it right from your app on your phone, your E-Trade, whatever brokerage app that you use. It's easy to diversify because when you're buying into a fund, they own multiple properties in multiple different markets. And the minimums are the lowest that you'll have in real estate because a stock of a REIT could be $10 as opposed to needing $100,000 for buying your own investment property. Now, the drawbacks of that is that there typically are very high fees because you have to support all the employees at that company and their executives, etc. You typically have lower returns, and it's also volatile because of the stock market. So even though you can receive dividends like clockwork, the value of your stock could go down a lot. I invested in a REIT a couple of years ago that dropped 60% in value. Even though it's given me the same dividends over time, it did not look good watching the value of my investment go down that much, because getting back to square one will be much, much harder. And you don't get the tax benefits because the company takes them. So next is sort of a hybrid of both. You can invest in a syndication. So with people like us, the benefit of doing this is that you're still passive. You don't have to be responsible for anything, but you still have opportunities to learn. So when you invest with us, we put out educational content. We also make ourselves available if you have any questions. You also get strong returns. So the projects we bring to our investors typically far outweigh the returns that you can get in the stock market, for example. And as a part owner of a property, you would get a portion of the tax benefits as well. And the drawbacks of this method is that there's typically higher minimums. So most syndications require around $50,000 to $100,000 for a minimum, although some may offer lower. They're less diversified because you're investing in one specific property, and the fees could vary by the syndicator. So when you're making an investment, you have to make sure that the interests are aligned, that the syndicator isn't taking too much fees and getting no incentive to make the property do well. So it comes down to finding a good team that you trust and that has your interest aligned. Finally, you can do something similar. You can invest in crowdfunding. So websites like CrowdStreet, Fundrise, these kind of things. It's a similar concept as a syndication. You're still being a part owner of a property, but the minimums are far lower. They're typically around 5,000, 10,000, and you're still passive. Now, the drawbacks is that the fees tend to be much higher on these websites because the syndicator has to take their fees to keep the lights on, and the platform like Fundrise, they'll have to take their fees as well to keep their lights on. So you're feeding two teams. Typically, the reporting is not as clear, and the returns can be quite variable based on the investment strategy, and it's also illiquid. The second question I get asked all the time is, why mobile home parks? Now, first off, what even are mobile home parks? These are commonly called mobile home parks, manufactured housing communities, trailer parks, what have you. And they're typically a huge lot of land with pads that people bring in manufactured homes on. And these homes come ready-made from the factory, delivered right to there. And if you look closer the next time you're out driving, you'll see there's quite a lot out there. Now, some of the key benefits of investing in mobile home parks, first off, is that it's a realistic solution to the affordability crisis. Mobile home parks provide a realistic solution for a large portion of the population because it's the only form of affordable housing that's not subsidized by the government. The rents for mobile home parks are typically much, much lower than an apartment building. For example, a mobile home park in New Jersey might cost $600, $700 to rent the land compared to $2,400 to rent an apartment. So mobile home parks are self-sufficient. They don't require governments to fund them with Section 8, so they don't require your tax dollars to make it work. The second is that the demand for affordable housing is increasing. As you see on the news, especially with fears of recession, the demand for affordable housing is now higher than ever. You hear of all the layoffs from these big companies out there. Well, guess what? The people living in luxury apartment buildings, they're moving down. People in okay apartment buildings, they're moving down even more. So the renter base shifts downward when there's recessionary forces out there. And because there's no other form of housing that's more affordable than mobile home parks, the buck stops here. There is no other substitute for mobile home parks. that's cheaper. Next key benefit is that there are high barriers to entry. Because the mobile home park space is so fragmented, meaning that it's not owned by large institutions, it's mostly mom and pop owners, and they don't have good data and reporting, and it requires such specialized knowledge to operate, it creates a natural barrier to entry. So it's harder for other people to get in. And that means the returns are typically more attractive for investors. Next, it's recession resistant. Like I mentioned earlier, mobile home parks have outperformed almost every other asset class in the past 20 years and is the only asset class that has not gone down in value during a recession. With recessionary risks at all-time highs, investing in mobile home parks is going to be in high demand. Next benefit is that there's limited supply. Guess what? The governments don't like mobile home parks because it doesn't give them enough tax revenue for the tax value that they take up. So each resident in a mobile home park only gives around an average of $1,000 a year in taxes, whereas they use the local school system, the fire department, EMT, road work, etc., and they take up far more than $5,000 a year in tax benefits. So the equation doesn't work out, and governments all around the country have been shutting down mobile home parks because it doesn't make financial sense to them. And the second reason is that developers find the land that the mobile home park sits on to be far more valuable than the mobile home park itself. So they knock down the whole mobile home park. They tell everyone to move away so that they could put in a 200 to 300 unit luxury apartment building. And both of these forces drive down the supply of mobile home parks. So that creates a key opportunity because there's an increased demand for affordable housing, a high barrier to entry, and limited supply. It means that those people that know how to play well in this space can do very, very well. And last but not least, there's a lot of mom and pop owners, like I mentioned earlier. And mom and pop owners meaning individual property owners and not a huge fund like Blackstone or something. So they tend to be less sophisticated and more easy to come to terms with when it comes to negotiating an offer. And also, there tends to be more operational efficiencies that we can improve on to make the property better on day one. Now you see here, this graph shows you in the past 15 years, I know it doesn't go past 2015, that now you see in this graph here how recession resistant mobile home parks are. And if you look at around the 2008 financial crisis, all other asset classes have gone down in value. Apartments, industrial, self-storage, etc. And mobile home parks climbed steadily upwards. And it wasn't until recent years that self-storage caught up to mobile home parks. And here's another table to illustrate that in the past 25 years prior to COVID, manufactured homes or mobile home parks return an average of 15%. And you compare that to the S&P 500 of around 7.7%. And you also take the fact that out of 500 fund managers, only 3 managed to beat the S&P 500 on a 20-year time frame. That just goes to show that it's pretty hard to win big with stocks. On this other chart, you'll see during the financial crisis, manufactured homes were the only asset class that didn't fall in value. Others have gone down 3%, as far as the S&P went down 22%. And as you know, the more an investment's value goes down, the more it has to come back up to get back to square one. And that's why Warren Buffett says rule number 1 of investing is to not lose money. Because once you lose money, it's very hard to get back to where you were. Speaking of Warren Buffett, the biggest players love mobile home parks. Warren Buffett is the largest manufacturer of mobile homes with his company Clayton Homes. He's the largest financier of mobile homes with 21st Mortgage and the second largest lender of mobile home parks with Berkadia. So he is all in on the affordable housing space. Second is another famous investor called Sam Zell. He runs a REIT called Equity Lifestyle Properties, which is a $13 billion REIT that consists a lot of mobile home parks. And he was nicknamed the Grave Dancer because he had the courage to see opportunity where no one else saw and take action on it. And one of his biggest moves in his career was buying a ton of mobile home parks because they cash flow like crazy. They're very recession resistant, and they had some of the highest risk-adjusted returns you'll find on the market. And through that, he became one of the largest owners of mobile home parks in the country. And of course, the household names that you might know, Blackstone, the Carlyle Group, Apollo, they're all huge on mobile home park as well. And the third question is, why invest with us? So the way we run our team is very focused and specialized. We only invest in mobile home parks in a few strategic markets, and we do so with principle and organization as our priority. Our key tenets are to put math over emotion. There's a lot of times where emotions come into play in real estate. Maybe you almost get a deal, or you've already invested a lot into a deal, but you have to back out. We like to always step back and let the numbers speak for themselves. So we like to underwrite conservatively so that we can underpromise and overdeliver. Also, we're okay to back out of deals even after we spent money on them that we cannot recoup if we don't feel that the investment is right. Just this year alone, we've backed out of 4 deals and spent hundreds of hours and thousands of dollars on them that will never see the light of day because we don't feel like it's the right investment for our investors. So we really put ourselves as a buffer for our investors because we know how hard it is for them to make their money and to entrust it with us. We don't take that responsibility lightly. Point 2 is that we focus on cash flow and appreciation. There's a lot of projects out there that promise you huge returns, but they really only come on the back end through appreciation once you sell the property or refinance it. For us, we want the best of both worlds. We really prioritize cash flowing properties because it's one of the best ways of reducing risk for our investors. Because once the money is in your pocket, it's in your pocket. Nobody else can take it away. So we invest only in properties that give cash flow and have built-in value add opportunities so that we could force the appreciation. We don't like to rely on luck for our properties to increase in value. We make it happen through a formula that's repeatable and scalable. Third, our investors come first. There's a lot of funds out there that have hidden fees and opaque reporting so that you don't really know what's going on. And we don't like that feeling. We've invested in other syndications and funds ourselves, so we know what we like to see as investors. And for us, it's clear communication and documentation of how the property is doing, the fees that we charge, and also being available should there be a question at any time. Most funds out there don't make themselves available like this because A, they're too busy, or B, they worry that there's too many questions. But for us, like I said earlier, we understand the trust that you put in us to be stewards of your investment. So we want to make sure that you're comfortable and that this will be the first deal of many. So we make ourselves available, communicate openly, and sleep well at night. And finally, we focus on creating good systems for our business, for our reporting, etc., to create a well-oiled machine that we can manage multiple things and not lose sight of a thing here or a thing there. We have strong SOPs and KPIs that we operate on to make sure that our investments operate like a well-oiled machine. And here's a bit on our strategy and what you can expect when you invest with us. So first off, you make your investment, we purchase the mobile home park, then we conduct our value add, we increase the profitability of the park, then we make distributions of the cash flow quarterly so that you can get a regular stream of cash flow, but also we're not needing to hire that big of a back office that eats into the amount that you would take home anyways. Then as we complete our business plan, we'll plan to refinance if it makes sense. That way we can return some of the investment back to you while keeping your same equity in the property. So this chunk of cash you get from the refinance is not taxed, and you can use it to reinvest to compound your wealth even more. Then once we reach the end of the business plan, we'll look to sell the property, or we might sell sooner if someone makes us an offer that we can't refuse, because our fiduciary responsibility is to make the best returns to you as we can. So if someone makes us an offer for twice the amount that we paid for in year 2, we'll take that offer, most likely. Now, to go a little deeper, how we generate value is illustrated in this table right here. So on the left, you have the net operating income of the property. You divide that by the cap rate to get the value. You deduct the debt that you have on the property to get the equity value. So in illustration, year 1, we have $70K in net operating income. We increase that through to year 7 through rent increases, utility bill backs, infill, and improving collections. The cap rate that we calculate typically goes down because the quality of the asset goes up. So we like to buy class C, class B minus, and move it up a class. Now, of course, in our underwriting, we don't assume that this is the case, but this is icing on the cake. Through time, we also pay down the debt with the rental income that we receive. So that leads to a residual growth in the equity value. So through leverage and the capital structure, we get a huge return for our investors. In summary, we believe that mobile home parks are the best asset class in this part of the market cycle, providing strong cash flow and returns even in a recession. We get the right people to purchase the right parks and apply the right business strategy to bring value to the community and to our investors. If there's any other questions, please reach out. Thanks for watching this video and good luck.